सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macrosutra. We're going to be talking about something that's happening that is near and dear to all of us. It has to do with our level of savings, and it also has to do with our credit card spending and the loans we're taking to fund our expenditure. These are important issues because one is going down while the other is going up. And to get into the nitty-gritties of it, that's what we're going to discuss in this episode. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint. And with us, we have Radhika Pandey, Associate Professor at NIPFP. She's gone through the data and she can tell you everything that's happening with all of our money. So now, Radhika, I'm going to start unusually. I'm going to start with an audience question because it's the most basic of questions, which is what constitutes household savings? Does this data also include things like the SIPs that we do? And because the data is showing that the SIPs have reached a historic high in August, and this is a question by Sankalp. So he says that isn't this contradictory to what everybody else is saying that our savings have come down?
So household savings consist of two components.
Mm-hmm.
One is household savings in financial assets.
Right.
The other is household savings in physical assets. So these
Right.
the sum total of this constitutes the overall household savings.
Right.
Now this data is a very lagged data. It comes with a lag of 2 years. The overall data on household savings comes with a lag of 2 years, and it's released by the Central Statistical Organization, our statistical agency. Then it gives a breakup of households' financial as well as household physical savings. But at the same time, the Reserve Bank of India also provides data on household financial saving, that is households holding of financial assets and liabilities.
Mm-hmm.
So that is what we are discussing here. So we are only right now what we have with us, which was released as part of the September bulletin of the Reserve Bank of India, is the data on households financial assets or savings, household financial savings, which again consists of a number of instruments, because household, when we say financial savings, they may be holding household financial savings in the form of deposits, mutual fund, units of mutual funds, systematic investment plans, provident funds, insurance funds, as currency in small saving instruments. So there are a range of instruments in which the households are keeping their financial savings.
Right.
So what the data is telling us that the household financial, the net household financial saving as a percent to GDP has come down in last year, that is 2022-23. This is not this year. Okay, so this is the
it's
last
up to
financial.
March.
It is up to March 2023. It tells us that the net financial saving, which is after excluding liabilities. Okay, so when the RBI releases data, it also gives data on financial assets, which is households holding of financial assets, as well as household liabilities.
All the loans and borrowing that they've done.
So we are keeping our savings in bank deposits, but we are also borrowing from bank. We are also borrowing from liabilities. So the RBI data on financial savings presents a picture of both. That is our holdings of assets as well as our liabilities, which may again be from banks, NBFCs, other non-financial corporations, etc. So net financial saving is when we have excluded the impact of financial liabilities. So gross financial saving minus liabilities is net financial saving, and it is that component which has gone down. But coming to the question of SIP, that part is, yes, it is captured as part of the mutual funds, because households holding of mutual funds is also captured in the overall financial savings data, which is released by the RBI. And there we do not see a decline. So this is corroborated by what Sankalp is saying, that SIP has been increasing. That is August 23 data, but even in 22-23, we saw that household attractiveness towards mutual funds, particularly systematic investment plan, has been increasing. So while the net financial saving as a person to GDP has gone down, but if we look component wise, the mutual fund household attractiveness towards mutual funds has not gone down. It is more or less stable.
I see. So now is that the trend that you're seeing overall in savings? Now, if you look at gross savings, so we look at savings and liabilities separately.
Yeah.
So if you just look at savings, is that also stable or has that also come down?
So if we look at gross financial savings, we don't talk about liabilities. So gross financial savings has, as a person to GDP, has gone down only marginally from 11.8 to 10.6%. So it's a marginal decline. It is a decline in terms of GDP, not in absolute level terms, but in terms of GDP, it has shown a slight decline. But if we look at the various, again, what's important is to look at the components.
Of course.
So what is happening to household savings in deposits? What's happening to household savings in, say, provident funds, in insurance policies, in mutual funds? And there we see a very interesting pattern. Particularly, bank deposits are the most dominant instruments of savings for household. And there what we have seen is that from 2021-22 to 22-23, the last two financial years, there has been an increase in terms of GDP from 3.5% to 4%. But this is lower than the pre-COVID level. Pre-COVID, we used to see on average household savings in deposits used to be around 4.4%, but it's still lower than that, though it has increased from last financial year.
So people are putting money in their banks and increasingly putting, but at a less rate than they were earlier.
Yes, as a person to GDP, it's still lower as compared to if we look at, say, 2019-20 or 2018-19, it is still lower. What has happened, if we just compare the last two financial years, is that household holdings of small saving instruments has gone down. Household holding of currency, liquid cash, also has gone down as a person to GDP. But households holding of insurance and provident fund are more or less stable. It's around 2 to 2.4% of GDP. So it's more or less stable. So the main story from here is that the gross financial saving as a person to GDP has only slightly gone down from last financial year. And within that, small savings, currency has gone down, equity has gone down as a person to GDP.
I see.
Mutual funds are stable, provident funds are stable, insurance are stable. So that is the overall picture emerging from the gross financial savings.
So that's an interesting insight into how people are increasingly saving. They're maybe not putting as much money in banks, but things like mutual funds are attractive.
Yeah, and that's intuitive because last financial year the deposit rates were not very lucrative. So and we saw a greater churning of savings. And if we just compare over a longer horizon, we see that, if we look at period of 2014-16, this period, and compare with now, households savings in capital market instruments like mutual fund, equity has increased. So there is this, the dominance of bank deposits as the principal source of saving is slowly, gradually getting eroded.
I see. And so now on the other side, if you're saying that gross financial savings have come down only marginally, then if the net number has come down, it must mean because liabilities have increased.
Have jumped. It's not only increased, they have jumped. So we see that net financial saving has gone down from 7.2% last year, that is 2021-22, to 5.1%. So almost it's a 2 percentage point of GDP decline. And the same increase is in liabilities. So increases from 3.8% of GDP to 5.8% of GDP.
So people are basically taking more loans.
They are basically taking more loans. Now, for what purpose and why they are taking loans? Is it a sign of distress, or is it a sign of shift from financial savings to more physical asset creation? That is something which we will clearly know when the NSO data on household financial and physical savings will come.
2 years from now.
Yeah, now 1 year because
Now 1
it's
year. Right.
But we can do some conjecturing based on first looking at the household financial liabilities data from RBI and then looking at what are banks doing, where are banks lending.
Right.
So we've already talked about earlier that personal loan segment is growing at a very sharp pace.
Yeah.
But what component has grown in 2022-23 that can shed light on the household's liability profile,
Right.
household borrowing profile. So if, as I said, in terms of borrowing, what the data from RBI comes, we see that there's a jump from 3.8% to 5.8% of GDP in terms of household financial
The liabilities,
yeah.
right.
And there we see that the increase, households are increasingly borrowing from both banks as well as NBFCs, that is
right.
non-bank financial companies. In terms of numbers, there's an increase of from somewhere around 9 lakh crore, 9 trillion to almost touching 16 lakh crore. This is the overall household financial liabilities.
Right.
And again, the biggest component is the bank that households borrow from banks, where there is increase of somewhere from 7.8 lakh crore to 12 lakh crore.
Mm-hmm.
But as I said, NBFCs are also becoming a very important source of lending to households. Because of their own problem, we'll talk about that because they are not lending again too much to industry or other areas,
Right.
and they are also reallocating their portfolio towards households. So we have seen that NBFCs lending to household has also picked up sharply. It used to be less than 1 lakh crore and now it's 2 lakh crore, 2.3 lakh crore
Wow.
in just 1 year. So household liabilities has picked up, and it has picked up both for household borrowing from banks as well as from NBFCs. Yeah.
So now it's absolutely clear that households are borrowing more.
Yes.
We'll get to whether this is a good thing, bad thing, all these value judgments we can conjecture about later. But getting into the breakups of
Right.
what kind of lending that these households are doing. I mean, if they're borrowing to build a house, that's one thing. But if they're borrowing to pay for essential spending, then that's another thing.
Correct. So that we do not know from the RBI is this data which came with the September bulletin, but we get to know some insights looking at the commercial banks retail loan portfolio, because there we get the breakup. Because when households are borrowing, they may be borrowing, as you said, for housing, they may be borrowing for vehicle loans, education loans, credit card outstanding, consumer durables. So there are, and then advances against fixed deposits. So there are 6 broad categories of banks lending to consumers or households.
Right.
And if we look at this, what we see is that one main thing that has happened is that the credit card spends by household has increased at a sharp pace from last financial year to this. There's been a 30% increase in credit card spend from 2021-22 to 2022-23. Even, leaving aside the COVID period where we had depressed spending, even before that, we used to see a growth of 30 to 35%. But the difference this time around is that it's happening on an already big base, already bigger number of. So 2021-22 credit card spend was almost 1.48 lakh crore, and now it is touching 2 lakh crore.
Like 30% more than that.
30% more than already a big number. So that is something to be looked into, because this credit card spending, if we again look at other data sources, it shows that credit card spends by tier 2 and tier 3 cities has also picked up, and it is being used for different purposes, from online shopping to utility payments, to travel, tourism, a lot of things.
Right.
So it is very hard to conjecture just by looking at credit card spending that it is for financing consumption or it is for financing physical asset creation or for recreation like travel and tourism. So that is one element.
And also, it's not necessarily a sign of distress, because there are a lot of people who they get a lot of credit cards and then they spend them for the points. They do it strategically.
Right.
They'll get one airline oriented one to buy only tickets. They'll get one that gives you more points if you spend at restaurants. And so they spend through the month on their credit card, and the next month when their salary comes, they pay off their loans. So that's not a bad thing at all. The problem arises if defaults start happening, and that data is starting to emerge now, and we'll need a little more time to see whether credit card defaults are becoming a big problem or not.
Yeah, so that is a risk that, because it leads to accumulation of high interest debt.
Yes.
If you don't pay within 45 days, then it leads to accumulation of high interest debt.
Right.
Then it tends to become a problem. So that is one part. The other part is also consumer durables. Consumer durables, loans for consumer durable has also picked up from somewhere average around 150 to 160 billion rupees to now 200 billion rupees.
Oh, wow.
So this is something which can also be explained by the pent-up demand, because 22-23, the last financial year, was the first normal year after 2 years of COVID-related disruption.
Right.
We have 2020-21 first wave, 2021-22 even worse, the second wave, 2022-23 leaving aside the January period when we had the small third wave. Overall, it was a normal period. So there was an increase in consumer durables spending also, and taking loans for consumer durables. So that is also one thing which has seen an increase. The other thing is vehicle loans. Loans, if again we look at 2022-23, after a 3 year of lull, we saw vehicle loans showed a jump of 26% in 2022-23. Again, if we look at the composition, we see that it's mainly driven by multi-utility vehicles, which saw a jump of more than 33%. But even passenger cars reported an increase of 19%. So again, vehicle sales also grew, though the increase was more for MUVs and SUVs as compared to passenger cars. And the other thing is housing.
Yes.
Housing constitutes half of the overall personal loan credit portfolio of banks. And what we have seen is, looking at various reports from property consultants like Anarock, we have seen that the demand for houses have jumped up by 48% in 1 year, in 2022-23 across the 7 major cities. We have seen that the overhang of inventory has gone down. So that is again showing that people are borrowing money for asset creation. And one of the main reason is also the now stringent regulatory framework for real estate sector in the form of the Real Estate Regulatory Authority, which has led to completion of projects and given a kind of confidence to home buyers that they can go ahead and buy homes.
Right, of course. So when this data came out, in fact, the savings and liabilities data, there were a lot of news stories saying that net savings has come down to historically low levels. And so the government came out with a response saying exactly this, that it's not so much a matter of savings, it's that people are borrowing for asset creation.
Right.
So they're either borrowing for building a house or they're borrowing to buy a car.
Right. So,
but now the thing is that I looked at the data of car sales versus taking loans to buy a car. While the loans to buy a car has, as you said, it's grown very sharply, the car sales figure is mostly flat. So, I mean, does that mean that the sales are mostly happening in the upper categories of cars? And so basically it's not that all the Aam Aadmi, we're all going and buying cars. Is that one segment of the population is buying expensive cars?
So as I said, 2022-23, we saw vehicle sales, passenger vehicle sales picking up by 26%.
Right.
And when we say passenger vehicle, it consists of passenger cars as well as these big SUVs. So while SUVs definitely sales have increased by more than 30%, but what the data is telling us, this data from SIAM is telling us that even passenger cars sales grew at 19%. So again, this is coming at a low base, and we have to see what happens this year as well. But because we are talking about 2022-23, the last financial year, and there if we see overall, we look at annual numbers of 2022-23 comparing with 2021-22, there is a 19% jump even in passenger car sales. So that shows that there is an increase. So many people have commented that, shift from, there is a visible shift from financial savings to physical saving.
Right.
And as the government pointed out, that it's not necessarily bad. It is not necessarily bad, but if this trend is sustained over a long period of time, then we need to see why financial savings are falling, because financial savings also need to pick up, because we know that in the three sectors, the household, government and corporate, household sector is the net saver, the surplus sector.
Yeah,
so if households are not providing adequate financial savings, then the ability of government to finance capital expenditure will be limited, or the ability to bridge fiscal deficit will also see a decline. So it's important to increase financial savings, and we need to see why financial savings are not increasing, why people are shifting towards physical savings. Is it due to lower interest rate, that financial savings are not that lucrative? So there are a number of factors, and yes, 2022-23 has told us that, this year data tells us that there is more shift towards physical saving, but we need to see what happens in this financial year and whether this trend remains as sustained or there is again a reversal towards financial savings.
Right, and of course there will be critics of the government also who will say that this implies a stress on incomes, because if people aren't saving enough and they're preferring to put their money in very, very safe areas such as a house, then that's a sign of distress. But again, we won't know that until we have more data.
Yeah. So I think once we get the data on household savings, which will also give us data on households' capital formation, because savings and capital formation data comes together, and then we will know where these savings are being allocated. Is it leading to higher physical capital formation, which is also good, but we need to see. Right now we can only conjecture based on the retail loan portfolio of households.
Right. And now there's also a lot of talk about the K-shaped recovery from the pandemic, that there's one segment of the population that is doing quite well, but the other segment is not doing that well. And so Uday has a question about this mixed data, as he calls it. He says that there seems to be mixed data with lower savings and growth in small personal loans. But at the same time, there's a big boon in big ticket purchases, which he's saying shows disparity. Are these signs of a K-shaped recovery, he asks?
Yeah, so it's hard to tell, as I said, from the current level of data, because we don't have income level data on who is saving or who is borrowing. We do not know that, but because there has been a broad-based increase in retail loan portfolio, it is very difficult to say that it's a K-shaped recovery, because we have seen increase in consumer durables loans also, we have seen increase in vehicle loans, we have seen increase in household houses loans also. And then when we look at this data and we compare with looking at the reports of these real estate consultants, it's not only the high-end houses which have definitely whose sales have grown up, but the mid-level housing are also coming up.
Also,
and even in this financial year, it is expected that household houses sale boom will continue in this year as well. So that is one thing. But yes, the other point is definitely that 2022-23 was also the year when inflation was above 6% in 9 out of the 12 months.
Right.
So it was above the upper threshold of RBI's 6% inflation. It was above that. So yes, there would be some poorer households who would have to borrow to keep their consumption stable. But that is the kind of data that we do not get. We do not have income level data. But yes, there would be the fact that inflation was higher and at the same time savings was lower. Do point out that there would be some section of households who would have been impacted by higher inflation, and therefore their borrowings would have increased.
Right. And now Aditya has two important questions. I mean, it's one question which can be broken up into two parts. So one is, he asks, are we seeing this happening in other major economies as well, or is it only an India phenomenon that financial savings are going down, whereas physical asset creation is going up?
So in other countries, particularly in advanced economies, it is due to the fact that during COVID, a lot of money was given into the hands of households. It was, but that is not something that happened here, because here we followed more or less a conservative fiscal policy. There was some targeted transfers, but it was not a broad-based transfer of money to household, which could have translated into higher spending by households or higher borrowing by households.
Right.
But here we see it's a combination of number of factors. First, definitely is pent-up demand. Secondly is for housing, we are seeing that the sales have become more robust. And again, millennials are buying houses. Some people are upgrading their houses. So, and with good regulatory framework, confidence has increased. So, the boom in housing market is here to stay, at least for this year as well. So 2022-23 as well as this year, we are seeing that has increased. Also, what is happening is that the households' borrowing sources have become more diversified. Households are borrowing not just from banks, they are also borrowing from NBFCs.
Right.
The non-bank financial companies are also wooing the retail segment to lend to them, because they feel that they are the more lucrative segment. They are, because what NBFCs do, they borrow from banks and then they lend. So they are also borrowing. So now if their cost of borrowing from bank increases, they would also like to give loans at higher interest rate. So what's happening is that they are giving loans, also unsecured loans are being given by NBFCs. So while for consumers it is good, but in the long run it may not be, because that could increase household indebtedness further. So there are a number of factors at play that, NBFCs have been shifting their portfolio towards retail. Banks definitely are lending. There is pent-up demand, there is inflation, but then there are other factors also at play, and this shift from financial savings to physical savings.
Right. So this actually leads quite well into Aditya's the second element of his question, which is, does this increase the risk of an NPA problem rising, non-performing assets? And what you were talking about, unsecured loans, probably does.
Yes. So we've already talked about that one level of this stress is already visible when we look at the RBI's financial stability report. They say that some pockets of retail segment are showing signs of stress. They are showing some signs of default. And one of the main reason is the increase in unsecured loans by both banks as well as NBFCs. And even, there are some studies conducted by these rating agencies who look at the credit profile of non-bank financial companies. And what they say is that NBFCs are going to rely on households. They are going to lend to the retail segment, because the other sources of demand are subdued. So they are going to lend. And if they are going to lend, they are also looking at unsecured loans, because it's more risky, but it also has higher return. So it could lead to problems, because if they're unsecured loan, it could impact the credit profile of NBFCs in terms of rise in NPAs.
Right. So on that note, that's what we have. Gross financial savings of households has come down, but not by that much. It's a marginal amount. What has gone up by a large amount, a big jump, is the liabilities of households. And this isn't entirely a bad thing. It looks like more people are borrowing more for asset creation, to buy houses, to buy cars, that kind of thing. But on the other side, there is a risky element that there's more borrowing that's happening from NBFCs. A larger chunk of this borrowing is happening in terms of unsecured loans. And so this could increase the risk of non-performing assets in the future, but we'll have to wait and watch. And whether this shows any sign of distress on incomes of people, that again, we don't have enough data right now to say. Once the data comes, of course, we will be the first ones to tell you. But on that note, thank you so much for watching.